Get Rich Education is brought to you by Norada Real Estate, Corporate Direct, and Mid-South Home Buyers.
Garrett Sutton here, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate and paper asset holdings with the right mix of LLCs and corporations. My firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention Get Rich Education for a free bonus. Switch your resident agent service to us and receive another bonus. It's all good. We look forward to assisting you at corporatedirect.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE. This is Get Rich Education, episode 96. I'm your host, Keith Weinhold, back to help you build durable wealth for yourself. Another week here. Today, you're going to hear a recent interview where I was the one being interviewed for a change. We're playing that here on GRE today as I chat with the real pro of an interviewer who has a long-time media presence herself, Kathy Fettke. She really knows what to ask to pull the gold out of me, as you're going to see. So today, I'll be the one answering the questions rather than asking them. As you would expect, I'm not going to talk about any of, that same junk that the mass media says about building wealth, like speculating on what stock might go up or might go down. Even when stocks go up, they don't provide real wealth for buy and hold investors anyway, unless you're an insider maybe, and having insider information with stocks is often illegal anyway. Instead, it's having specific knowledge about these sort of niche boutique type of providers that I share that can create wealth for you. So if CNBC never invites me onto their show because I don't tout the blue sky that stock pundits sell to people, at least I'm staying true to myself and, true to you, helping you build your wealth to a point where it can potentially create a real difference in your life. That interview with me is coming up in a few minutes, but let me lighten it up for a minute until we get into our serious weekly investing chatter, okay? Just a few minutes ago, I finished a really cool phone call with a really cool person, and talking to this person makes me feel like I live a rich life. That is my grandmother, Grandma Weinhold, my dad's mother, who lives in Lancaster County, Pennsylvania. The fact that I can talk to her on the phone whenever I want to, that's an asset to me, okay? The fact that she's 90-some years old and still lives in a home by herself and has a good mind and has good hearing, and I can talk to her just like I'm talking to you right now, is just simply amazing to me. What I mean is that she can understand me so well, like I don't even need to speak excessively loudly. I don't have to slow my speech down. I can talk to her just like I'm talking to you now. She's a Philadelphia Phillies baseball fan, and I know that the Phillies aren't doing so great this year. That's probably one of the few things Grandma Weinhold has to complain about at her age, which is remarkable. My parents listen to GRE most weeks, and they played a little bit of it for Grandma Weinhold one time. And I think that Grandma said she didn't quite understand how her grandson's voice was coming out of an iPhone. But anyway, I'm going to visit her here in Pennsylvania fairly soon. And yes, this is the same grandma that I have remarked before looks like Federal Reserve Chairwoman Janet Yellen. Maybe we'll post a side-by-side photo of Grandma Weinhold and Janet Yellen on GRE's Facebook page sometime, and you can check the resemblance yourself. It probably really isn't that close of a physical resemblance, but I don't regularly hang around women that are 2 generations older than me. Or look at photos of women 2 generations older than me that have short gray hair, so they probably seem more alike to me than they really are. So I feel rich in that I can just call my grandma whenever. And, I guess the takeaway here is that on today's show, we're talking about expanding your means and making yourself into more of what you ever thought you could be. But at the same time, it's good to look around and appreciate what you have, too. I'm appreciating what I have with Grandma, okay? So, yeah, that doesn't mean that we become complacent. We can appreciate what we have and achieve more at the same time. So, yes, it's the old, whoever said that less is more never had more, and why have more when you can have it all? Now, one thing that you don't want to do is hang out with the spend less crowd, okay? Avoid too much exposure or influence with the spend less crowd. How do they think, They're like, yeah, baby, we did not go to Hawaii again this year. We deferred our lives and lifestyles again. Okay, that's about what it sounds like. Yeah, let's celebrate. This year we paid an extra $5,000 toward our home mortgage, which creates 0 ROI for us. We drained our cash flow in the process and put off yet another year where we didn't buy the pair of kayaks for the lake. Yes. Okay. All right, come on now. Really, is that the life you set out to design for yourself? That is living a half-dead life. That's living half dead when we live in a world of replete abundance. Instead, when the difference, that delta between your production and your consumption increases, you can live better and give better than you ever thought you could. It's about cash flow and being financially free, not cash strapping and being debt free. Well, how do you get to a point from being an everyday Joe to producing substantially more than you consume? You do that by leveraging a loan from a bank and borrowing the efforts of others at the same time. Yes, the efforts of others enrich you, and you do it in an ethical way. So how do you get control of the efforts of others with relatively low hassle and relatively low risk? You will get those answers where I'm interviewed today. And let us keep in mind that investing involves risk. You could lose a lot of money in real estate if you surround yourself with bad people, a bad property manager, or a bad market in a community where there are job losses, okay? We talk about how to avoid that here regularly. So it's not about risk elimination. I don't think you can completely eliminate risk, whether you climb a ladder to get up on top of the roof, or you put your seatbelt on before a 20-mile drive, or whether you buy a four-plex building. So rather than being about risk elimination, it's about risk management, risk mitigation. Get some education and buy right, and the prospects for the financial upside will greatly outpace your prospects of financial loss. Have that strategy like we talk about in today's interview. Take a long-term view, and you have a fantastic opportunity to be a profiteer. Follow along in those words of Dale Partridge, okay? And you are bound to live a happier life. Here's what Dale Partridge says, and I just absolutely love this. Stop creating a life that you need a vacation from. Instead, move to where you want to live. Do what you want to do. Start what you want to start and create the life you want today. This is not rehearsal, people. This is your life. Those are the words of Dale Partridge. Just fantastic. And please, maybe I don't look at it like some cute quote that you forget about by the time that you eat your next meal, okay? Practice living it. What I say is that when you're writing the story of your life, don't let someone else hold the pen. You hold the pen. You'll hear that interview with me in a moment. This is Get Rich Education. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A-plus rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
My guest is Keith Weinhold, the founder of Get Rich Education, a company that teaches others the life-altering power of investing, especially through real estate. So, Keith, I'm super excited to have you here today because I know you've got a great story that will be incredibly inspirational to our listeners.
Oh, yeah. Well, thanks so much for having me on. It's great to be here, Kathy. I appreciate it.
So, how did you get started in real estate, and what was the story behind that?
Yeah, well, that's a great question because I did not come from a real estate family or an entrepreneurial family. I was born and raised in Pennsylvania, and a few years after college, I moved to a place that I dreamed of living, and that's where I've lived since, and that is here in Anchorage, Alaska, because I had vacationed here a few times previously. And, you know, I think it begins with the end in mind. You have to go for what you want. You have to live where you want. I think a lot of people follow money, and they move to where a job is, but in today's economy, you can make money follow you, be geographically independent, and live where you want to live. Mm-hmm. Well, I didn't quite exactly have a grasp on that after I moved to Anchorage because a few years after living here, it was just 2002. And what I did when it was time for me to sort of come of age and buy my first home, Kathy, is rather than buy a single family home, I bought a four-plex building. That's the first home I ever owned. So one day in my life, I went from being a rent-paying tenant to the next day being the one collecting the checks with a four-plex building. It's the first home I ever owned where I lived in one unit and rented out the other three.
That's exactly what we did. That's how we got in, except we bought a really large house, a 6-bedroom house that had an in-law unit and a separate business area and then kind of a separate entrance to another bedroom. So we were able to turn a big home into a four-plex. And you know, like you said, you go from being a renter to being a landlord overnight, and all that income can pay your expenses.
Yeah, and you know the thing about it, Kathy, that very thing right there, that sounds daunting to most people the way that you and I started. But as I bought a fourplex building that was already set up as a fourplex with what we call townhouse style, where the tenants live side by side, what I was able to do, and why this is a much more approachable than what people think, and you probably know this, but all you need to do is put a 3.5% FHA down payment on a property. You can use that 3.5% down FHA program for a single-family home, a duplex, a triplex, or a fourplex.
You can go up to 4 units. That's right. And just put 3.5% down. It's brilliant. Even back then, you could do that in 2002?
Even back then, you could do that. So, you know, here in 2016, you can still do that same thing. You know, the PMI, the private mortgage insurance rates, are somewhat more punitive now than they were back then. But all one needs is a minimum credit score of 580 in order to qualify for that program.
Oh.
I mean, I think most people have a 580. In fact, if you have lower than 580, you just need to put 10% down.
Because you can still get the loan. And,
yeah.
Oh, by the way, you might add you can borrow that 3.5%.
That's right. That's
from
right.
Family.
Yeah. So it's really a remarkable thing. And of course, you know, you do have to go ahead and own or occupy for 12 months, meaning you need to live there yourself. But
You have to live in one of the 4 units.
You need to live in one of the units for 12 months.
And I'm so glad you mentioned that, because a lot of people think, oh, if I'm going to do that, buy a primary and rent out other rooms or unit. I mean, you could just buy a house and rent out the other rooms to make the numbers work. People just see this huge obstacle, and I'm so glad you brought it up. Anyone can do this, and you don't have to stay there forever. You can just stay there a year. I mean, there's no hard, fast rule on that, is there? That you have to live there a year?
There are some extenuating circumstances where I've seen people get out of it, even if they wrote a letter at the 9-month mark saying we're getting married and need to move out to another place. I've seen FHA accept that. So, like you said, Kathy, it really doesn't take that much to get in other than knowledge. It just takes having that specific knowledge in knowing how to get in.
Absolutely.
And, some people were thinking, well, I don't know if I could service the payments or if I'm going to qualify. But, the important thing here is that when you buy a four-plex building, live in one unit and rent out the other 3, you can take those other 3 tenants' leases, show them to your mortgage loan officer. You can use 75% of that rent income toward qualifying for the building for yourself. So look at what you've really done here. Conceptually, you've begun using other people's money before you've even bought the property, because you're using that toward qualification. And as you and I both know, other people's money is key. A lot of people think it's fantastic if they can get their money working for them. But I think, from you and I's perspective, we probably agree that getting your money to work for you, if that's the best and highest use of your dollar, that you're getting your money to work for you, that's a middle class concept. Getting other people's money to work for you, that's what the wealthy do. And that doesn't mean that you're exploiting people. Like, I provide them with housing that's clean, safe, affordable, and functional. I make sure that part of the mission's done, and then I can feel good about being a profiteer and using other people's money. Now, when you buy a four-plex building that way, or really any investment property, any turnkey property out of market, you're using other people's money 3 ways at the same time, which is fascinating. You're using the bank's money for the leverage to get high rates of return in an appreciating environment. You're using the government's money for generous tax incentives, and you're also using the tenant's money to service that debt and hopefully get cash flow. So you're using other people's money 3 ways at the same time. That's what builds wealth.
And yeah, absolutely. There is no excuse to not be able to jump in. Anyone can do it. And with those incredibly low credit scores, it's amazing. The one thing that would keep people from getting a loan would be debt to income ratios. There's not a lot of leeway there. So you've got to pay down your debt. I'm not really sure what the FHA rules are there, but normally it's 43%, I believe, debt to income.
I still find the debt to income ratio hangs up probably just about as many investors as anybody from moving ahead, as long as they have that down payment. But you bring up a good point. It's important for a prospective investor to learn about things and find out what their debt to income ratio is. It kind of floors me, Kathy. What do most people in America and the world do? They go to work. And a lot of people are not passionate about the work that they go to, but yet they will take an amazing amount of time to learn about how work works. So the average person learns about how work works. They don't learn anything about how money works, and yet money's the only reason that people go to work.
It is really ironic, and I think partly we've been brainwashed to think that way because the world needs workers, and that's what we're trained to do. But some of us can look beyond that and say, yeah, well, I've got a limited amount of time here on earth, and I'm going to use it to my greatest advantage. And it's almost like cloning yourself with little money machines that do the work for you.
Yeah, that's right. And, I brought up leverage. Leverage is getting a loan, and leverage is doing the work for you. And, you've got some people that are opposed to leverage and some people that don't even understand the concept of leverage. Let's talk about leverage for a moment. I mean, it was Albert Einstein himself that said, compound interest is the 8th wonder of the world. Well, I wonder if Einstein knew what leverage was. Leverage can create fantastic rates of appreciation. Yeah. Let's just take a 3.5% down payment on a property. We don't want to get too mathematical in an audio medium, but that is 28 to 1 leverage because 3.5 is 1/28 of 100. So what does 28 to 1 leverage mean? That means for every percent of appreciation you get in a property, your down payment, your portion invested, increases 28 times. So if you have a 5% rate of appreciation on a property, that's a 140% rate of appreciation on your down payment, and that 140% is one of only 5 ways that you're paid with real estate. That's leverage. That has real power in one's life and creates real wealth, where compound interest is just really slow. It does not, unless you have fantastic rates of return over time, create wealth with compound interest. It's leverage.
I have been doing this for 15 years and no one has ever put it in terms like that. That was really well said. I love it. All right. So you said that was one of, I think, 5 ways. What are the other 4 ways to build wealth through real estate?
Okay, I'm glad you asked. Let's see if I can remember them all while you put me on the spot. Number 1 is appreciation, which is greatly amplified with leverage. Number 2 is the cash flow. Now, that's the liquid money that you feel in your pocket every month, because every month, hopefully over the long term, your property's income will exceed its expenses or you wouldn't buy it. The third way is through generous tax incentives like depreciation and the mortgage interest tax deduction. The fourth way is loan amortization, as your tenant pays off that loan balance little by little for you every month. And then the fifth way is a significant inflation hedging benefit. All 5 of those ways are how one profits at the same time. That's why they say that landlords get wealthy in their sleep. It's those 5 ways right there. And, most people that are investing in real estate don't even realize how they're financially benefiting in 5 ways at the same time when they're a leveraged, cash-flowing real estate investor that buys in a sustainable market.
Beautifully said. That is great. All right. Coming back to you, you got the four-plex. How long did you actually live there, and do you still own it?
I don't own it any longer. I lived there for a little over 3 years. So, I could have lived there for as little as 12 months, like we discussed earlier. But, and this is going to maybe surprise some people. When I bought that four-plex building, I wasn't that excited about real estate investing. I wasn't that excited to move out and go on and get the next property because I'm young and having fun in life. It was only until later that I realized what this building was really doing for me.
But you kept it or you sold it?
I sold it now, but I ended up keeping that building, Kathy, for about 10 years. And so after living in that first fourplex, after 3 years, I moved out into a single-family home, realizing that that's a quality of life decision. We can't get the quality of our time back once it's gone, living communally in a fourplex. And then just 2 years after that, I bought a second fourplex. So after a total of 5 years, I've got 2 fourplexes in the single-family home that I moved out into. And by that time, I learned, don't buy the second fourplex with my own money. Remember, we want to maximize the use of other people's money here. So what I did is I did a second loan, home equity line of credit refinance from the first fourplex and used that as a down payment on the second fourplex, using other people's money, the banks, with leverage. So I basically have no skin in the game when I put 10% down on a second fourplex with the equity from the first fourplex. And, I think this is a really key point here. A lot of people would just be concerned with paying off that loan on the fourplex over time rather than expanding. A lot of people focus on trying to be debt-free. I'm telling you right now, I know you know this, Kathy, I'm telling your listeners, you don't want to be debt-free. You want to be financially free. The fact that you want to be debt-free often prevents a person from being financially free, in fact.
Wow. Again, really well said. And we have an audience of people who are, very close to retirement or in retirement, and they really want to be debt-free. And this is a conversation that we have a lot. Is there a time when it's better to pay it all off? What do you think?
Yeah. Well, and of course, we need to qualify that with what good debt is. I don't see any reason or any limit or any reason why I wouldn't want my home to be completely leveraged even when I'm 80 years old. Okay, I'm pretty young now. We'll see what time brings me. But, if I can have those dollars rather than trapped in the walls of my home, out working for me somewhere else, earning a rate of return that exceeds the note rate on what mortgage I could get, yeah, I want to do that. I want to go ahead and take care of that because I do have debt, but every part of that debt that I have associated with leveraged cash flowing real estate in a sustainable market, every piece of that debt is outsourced to tenants. So effectively, it's not truly my debt. I'm not going to be the one responsible for paying it down.
You just have to make sure you buy the right property that people want to live in and pay you to live in, right?
Yeah, that's right. A lot of people think about the property. They think about the property first, but in real estate investing, the property is really only the fourth most important thing. Number one is, what about you? It starts with you, the investor. What do you want? Do you want cash flow, appreciation, tax advantages, lifestyle investing? Secondly is the market. Third's the team of professionals that secures that income stream for you. And then only fourthly is the property.
Absolutely. All right. So when you borrowed the 10% from the first fourplex and bought the second fourplex, basically on the borrowed down payment and borrowing more money to acquire, How do you even calculate the return on something like that when you haven't put any of your own money in?
Yeah, that's right. That's right. It's effectively infinite. So, I really think it comes down to making, I guess, bold moves is what it really comes down to. I mean, people perceived it as a bold move when I moved from Pennsylvania to Alaska. They looked at me like I was trying to colonize the moon or something. Then when I purchased a four-plex building as my first home after doing some reading about it and being motivated about it by Rich Dad Poor Dad like so many people have been, to buy a four-plex building, that was perceived as bold from a lot of people. Well, the next thing I did that I guess some people perceive as bold is I sold both of those four-plex buildings, Kathy, and I went ahead and 1031 exchanged them into an 11-unit building and an 8-unit building. And these properties are all here in Anchorage, even though I invest nationally and internationally. We're just talking about Anchorage, Alaska here. So, you just have to keep burning the bridge behind you once you have a belief so great that what's ahead of you is going to be greater than what you're leaving behind. So even those were two profitable four-plex buildings. In 2013, I sold both of those and replaced them with about $1.9 million worth of real estate with an 11-unit building and an 8-unit building. So what did I just do there? I took on more debt than I had ever had previously, but I also took on more tenants. I went from 8 tenants to 19 or 20 tenants, so I have just as much ability for them to go ahead and service that debt. And additionally, often when you get bigger properties, they're more profitable on a dollar-per-dollar basis. So I now had more cash flow than ever. Okay, again, moving closer to being financially free because I had 20 units rather than 8. I moved closer to be financially free and less close to being debt-free. So I'm giving you an example here of how I took on about $1.2 million worth of debt with those two replacement properties, but my cash flow went from $1,500 in the two fourplexes to $3,500. And that's accounting for every possible expense those buildings have: principal, interest, taxes, insurance, maintenance, management, which is key. That's what makes it passive, and utilities. So again, I took another step toward being financially free and a step away from being debt-free. I want to avoid that scarcity mindset of thinking I need to have my debt paid off.
Very good. What else have you done? You said you're investing in other parts of the country. When did you start that?
I started investing in other parts of the country in about 2011, Kathy. The Anchorage, Alaska market is bustling and robust as it's been, where there's been job growth. The economy's not very diversified here. We're so dependent on the price of a barrel of oil. Economically, we've only got one leg, and that leg's been quite strong for a while, but you know what happened to the price of a barrel of oil. So, about 5 years ago, I began buying out of market, starting in Dallas. Memphis is another market I look at a lot, and even investing internationally a little bit. So with Dallas, I see that as kind of a lower cash flow market, but a more stable market, one that's really not vulnerable to economic downturns, because stability economically is something I seek as I look to diversify out of this market that really isn't very diverse.
Now, would you say that market has topped out?
I don't know about topped out, but it's become really quite a bit more difficult to make things cash flow in that market. It's just not one of the better cash flow markets. I'm not saying it's not a worthwhile market to invest in, but boy, it's so stable with all the Fortune 500 companies that are based in DFW and such. It's hard to think of a market that's more stable.
It is so stable, but everybody figured that out. We started investing in Dallas-Fort Worth, over 10 years ago. More like 12 years ago, and people would actually laugh at us, like, nothing happens in Texas, but it ended up being a really great investment, and everyone found out, and prices are up and cash flow's down. But like you said, still a great stable market. So what's next for you?
The next thing for me is to continue to diversify out of market. And, Kathy, at this point, I'm pretty concerned with what's going on in the Anchorage market with the price of a barrel of oil being so low. Oil companies have announced layoffs. Across the United States, I've often, at least anecdotally, heard the metric that for every one oil and energy job, 10 other jobs are dependent upon that, with whoever does your hair and whoever serves you at restaurants and so on. Well, in Alaska, for whatever reason, that ratio is for every one oil job that supports 20 other jobs, and some layoffs have been announced. So, I'm considering selling the 11-unit building and the 8-unit building because the prices have run up substantially over the past few years, just like they have in most places in the United States. But, we still don't have that economic uncertainty discounting those prices at all, and there is a lag effect. So, I've got to think about selling those and moving some equity out of market.
Are you seeing rents go down?
No, but I'm not getting any rent increases between tenants, but I do have terrific occupancy in those buildings, so that's good. There is that lag effect. So
Sure.
for now, still hanging on to these Class C multifamily buildings. But I think with what you're asking me and investing out of market and like Kathy, maybe why am I talking to you today rather than a different property owner in Anchorage? And I think it comes down to really it's because I value my time. I strive to have a better and higher use than to just be an everyday investor managing my own property. Life is too short for property management. Because I've outsourced that, I have time to go to network at seminars or meet bright people like you and be on your show rather than replacing a piece of hardwood flooring or a toilet flapper that came up or something like that.
Which is so funny because you live so close to your property. Some people might think you'd manage them yourself.
Yeah, you're right about that. But I think when you realize how broad the world is and how many opportunities are out there, you begin to realize what opportunity cost is. As soon as you say yes to something in life, you say no to something else. Just because I do know how to redo the cove base in apartment unit number 9 at my multifamily building doesn't mean that that's my best and highest use of doing that. So, you and I as real estate investors and real estate investing educators, Kathy, we throw around all these numbers, okay? We throw around all these numbers like cash on cash return, internal rate of return, return on investment, return on equity, cap rate. We throw around all these terms, but the one metric that everyone needs to be analyzing that no one ever really does, and you've definitely never seen it on a Microsoft Excel spreadsheet, is that what is your ROTI? What is your return on time invested? Are you truly migrating to your best and highest use? You can find people to outsource lower uses to all the time. So what's your return on time invested? And as time goes on, the great thing about the return on time invested is the denominator in that equation is your time, and your time invested goes down with each successive investment that you make because you learn that much more and you have that much more experience. So because your time is reduced and your return stays the same or goes up, your return on time invested just continues to increase over time. So your return on time invested is the most important investor metric you've got.
Yeah, and I think too many people just don't value their time enough. It's an easy trap.
Yeah, there's a lot to be said for that. So I really implore people to just not settle for things and instead to expand. One of my favorite quotes is the Robert Kiyosaki quote, "Don't live below your means, expand your means. As long as you're thinking, you might as well be thinking big." Think about being aspirational. Read about how a 1031 exchange works and all the ways that benefits you. And you're not going to try to self-manage for long, okay?
Absolutely. Okay, one final tip. I think you just gave one, but what will be one final tip for our new investors?
Well, this isn't going to sound like a tip in the beginning, but this is a tip, okay? And that is this. I own a multi-billion-dollar asset. Yeah, I said that right. I own a multi-billion-dollar asset, and so do you. It's your mind. So whatever you think is possible or whatever you think is not possible, it's all a product of what your mind is telling you. So, don't settle. Expand to the upside. It's much more powerful, and the upside is unlimited. Don't live a day below your means.
I love it. Keith Weinhold, you are the host of, tell us the name of your podcast.
Oh, it is Get Rich Education, where we use an abundance mentality to invest in real estate for an outcome of not more doors or not more cash flow, but how that conduit actually improves your lifestyle. And we're on every week.
Wonderful. Thank you so much for joining me.
Well, yeah, I really appreciated that chat there. I want to relate that expansionary mindset and patterns of action to you. You need to ask what you're making of yourself. There's a meme floating around out there, okay? Just consider this. Say that a bar of iron costs $5, all right? A bar of iron costs $5. If that bar of iron is made into horseshoes, it is worth $12. Made into needles, it is worth $3,500. Made into balance springs for watches, it is worth $300,000. Just the same way, your own value is determined also by what you are able to make of yourself. I'll repeat that. A bar of iron costs $5. Made into horseshoes, it is worth $12. Made into needles, it is worth $3,500. Made into balance springs for watches, it is worth $300,000. Just the same way, your own value is determined also by what you are able to make of yourself. Again, stop creating a life that you need a vacation from. Instead, move to where you want to live. Do what you want to do. Start what you want to start and create the life that you want today. This is not rehearsal, people. This is your life. If you're afraid of failure, just consider that fear and doubt destroy more dreams than failure ever does. It's having specific knowledge about these niche boutique type of providers that I share with you that can create wealth for you, like those same ones that are under your resources tab at GetRichEducation.com. Well, I've really liked chatting with you this week. I'll be back with you next week for another wealth building show. Until then, take care, live abundantly, and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.